I know this is a fascinating subject. It's kind of hard to grasp and get a hold of. What's up, everyone? Kevin Amalsh, Pine Financial Group. We work together so you succeed. Hey, you found us here on Facebook. You found us here on YouTube. Please help me build the channel. We're trying to help more real estate investors. If you could do me a favor, hit subscribe, hit like, maybe mash on that notification button so you know every time we have fresh content. That would be awesome. Hey, I got a interesting topic today because I had an email exchange with a client. We were looking at an investment property he wanted to add to his portfolio. And what I noticed is his cash on cash return. Well, the return on the property, but cash on cash in just a minute, but the return on the property, or the return the property was producing, was less than the leverage rate. So the amount of the mortgage that he could borrow at today. So we call this negative leverage. And I was trying to explain to him why I would be a little more careful purchasing a property with negative leverage. And I was trying to do this through an email exchange with them. And gosh, I think I confused myself because it's very hard to describe this in an email. So I thought, hey, maybe I'll just jump on here real quick, do a little video so that I could help people understand what negative leverage is and some of the risks associated with that. So negative leverage is anytime you have a return on the property. So I'm going to use the term cap rate here. A cap rate is the return a property would produce, assuming there's no debt. So let's say there's no loan on the property, you own it free and clear. The amount it's producing in income is the cap rate on that property. So we use cap rates in commercial real estate often, and it's used to value property, or it's used for investors to make investment decisions. So they'll take the net operating income, NOI, and use that to come up with a valuation, which I'm going to show you here in a minute. What I'm going to do is share my screen so that you can see how this negative leverage actually works. It's interesting because with negative leverage, the more money you put down, the larger your down payment, the lower your cash on cash return will be, which is exactly the opposite as you would expect. You would think the less money into the deal, the higher the return on the dollar would be. And that's kind of what you want. So let's just use this little property analyzer that I built, this spreadsheet. And I'm going to take just a simple little, let's say a $300,000 house. So let's say it's listed at $300,000. And I think this house will rent for, I don't know, maybe $2,000 a month. I'm literally making this up as I go. So $2,000 a month in rent, which would be, this is on this spreadsheet, everything is analyzed on an annual basis, yearly basis. So we have to multiply that by 12. So we have a $24,000 per month potential income or scheduled income. Okay, then we just take out this. A lot of this is automatically built in, so it's easier when I'm running my numbers on properties. So I just assume a 5% vacancy factor. Obviously, you could change this to anything you want, and it will change the number, the impact on your analysis here. Accounting, this will be just for a tax return. You could take that out if you're just buying one little property and you're not setting up a separate entity for it. In fact, let's just go ahead and do that. We'll just take that out. Advertising fees, over 20 years of experience investing in properties and owning multiple properties. I like to budget about a 1% fee. This is going to be for like leasing fees or advertising fees. I think how often a property turns over, this is going to be pretty darn close to an accurate number of what you're going to spend for your advertising. Insurance, let's just keep it real simple, guys. Let's just say $1,200 a year in insurance, $1,200 a year in taxes. Obviously, I think your insurance would be a tad less than that, and taxes probably a tad higher than that. But the point here is about the negative leverage. So legal, so I just budget a little bit for any evictions that I might run into. Property management, let's just say 10%. You don't have any of these with this small of a property. I don't want to get into a lot of detail here, but 10% seems to be a pretty accurate number on single family homes. This number will go up with multifamily or anytime you have more common area maintenance. So if you think about like hallways and that kind of thing, larger roof, common boiler, furnaces, water heaters, all of that, that would go up. Reserve to replace is actually for those bigger ticket items. So setting aside a little bit of money every month to handle a larger expense. I like to use a 1.5% reserve to replace. Okay, so the total expense is $7,740. So our net operating income, what actually we get to keep before any leverage, $15,060 per year. Okay, so I'm going to say if it's a $300,000 purchase, to get that $15,000, that's going to put my return or my cap at 5.02%. So if I make the $300,000 investment to buy the property all cash, I'm going to get a 5.02% return based on my net operating income. Okay, so here's where it gets interesting. If you, let's just assume a 30-year loan, and let's just say 7.5%, and then you got to put your down payment in here. So let's say a 20% down payment. Okay, we're going to borrow $160,640. That's how much our loan is going to be. And we're going to put down $40,160. So our cash return for the year, $1,580. So a cash return is after you pay all your debt. So all your expenses, you calculate net operating income. From there, you subtract your debt payment and you get your cash return. So this doesn't distinguish between principal and interest. It's just a cash outlay for the payment. And you get a cash on cash return of 3.94%. Here's where negative leverage comes in. Because the cap rate's 5 and you're paying 7.5, if I reduce this, or let's say I increase my down payment, I want to put more money down. So I'm going to put $50,200 instead of the $40,000. Look what it did to my cash on cash return, 4.83. That's the exact opposite of what you would expect with a normal transaction where the cap rate is higher than your leverage. Those are the properties I would be targeting. So if I decrease this down to only 15%, you would hope that the cash on cash goes up, but you would see the cash on cash plummets with a smaller down payment. I think that the negative leverage is risky. Well, first of all, and this is what I was trying to explain to my client, if you're buying a property and the more money you put down, or let's say, I'll take that the opposite way, the less money I put into the deal, the less return on that dollar I get. So I'm lowering my return by taking on leverage, and I'm increasing my risk. So leverage is risk. You're borrowing money. They could foreclose if you default, right? So leverage, and that's what created the crash in 2008. Leverage is risk. Now, it should boost returns. So in this case, you're increasing risk and lowering your return. And so that's where I get real concerned. And what I was trying to explain to him in my email. Now, on the flip side, I think negative leverage could easily be a sign of values coming down. So let me give you an example. If I'm a real estate investor and I'm investing for a return, so this is what I would be doing in the commercial world, let's say, and I'm not trading on emotion like you see a lot of times with housing, then I might want to match my mortgage rate, right? So I might say I desire a cap rate of 7.5 because that's what I could borrow on my loan. Look what that does. 2.5% cap rate adjustment is a third of the value. So it went from 300 down to $200,000. So to me, this property that produces a $15,000 annual NOI is only worth $200,800. So I think when you see the negative leverage, you're going to see that there's a lot of room for cap rates to increase to get closer to the leverage rates. And when cap rates increase, the value decreases, as I'm showing you right here. And this is only 2.5% cap rate adjustment, and we're 33% loss to our value. Now, I do think that we're going to see some softening on the commercial side. I've talked about this a lot. It really has to do with the maturing loans, but I think negative leverage is going to come into play at some point as well. Now, on the residential side, do I think we're going to see a big crash in housing? I do not think that. And again, the reason is housing typically trades on emotion. People want to live there. They want to raise their family there. They're not necessarily buying houses based on a return. I mean, investors do that, of course, but they also sell to people that want to use them as primary homes. So you're not going to see the big impact to values with negative leverage as you will on the commercial side. So here, if you want that spreadsheet, give me an email and I'll send that over to you totally for free. It helps me analyze apartment deals or commercial deals that I'm looking at. I could quickly come up with cap rates, quickly come up with valuations based on my expected cap rates. So I know exactly what to offer my sellers. I'll give it to you for free at info@pinefinancialgroup.com. That's info@pinefinancialgroup.com. I know this is a fascinating subject. It's kind of hard to grasp and get a hold of. So if you have any questions, please leave me some comments below. Let me know what you think or what questions you have about the concept of negative leverage. And then we'll catch you on the next video. Check us out, pinefinancialgroup.com.